What if I told you that the most profitable financial trick in history has absolutely nothing to do with stocks, crypto, or real estate? In fact, the world's wealthiest titans made their fortunes using a business model that most people think is an utterly boring, money-draining headache. Commercial insurance. Think about it. What if there was a legal way to collect billions of dollars from massive corporations, pay 0% interest on that money, and keep every single penny of the investment returns for yourself? It sounds like an impossible financial glitch, but this exact mechanism created a trillion-dollar empire. And by the end of this video, you will see the exact blueprint of how this hidden machine operates, how it turns everyday business risks into absolute gold, and why the world's most powerful players use it to quietly control global commerce. Step back for a second. To even sit at the high-stakes table of commercial insurance, the entry price is staggering. Okay, so you want to buy a commercial insurance company. If your plan is to start a small regional agency, brokering basic liability coverage for local construction fleets and regional warehouses, you will need a baseline of $5 to $10 million, just to cover mandatory state licenses, legal reserves, and operational liability. Now, if you want to step into the big leagues, to become a primary commercial carrier taking on massive corporate risk, the entry cost jumps to a mind-blowing $200 million to $500 million. Why is the price of entry so absurdly high? Because government regulators do not care about your marketing or your sales pitch. They demand cold, hard liquidity sitting in locked reserves before you write a single contract. You see, unlike a normal business that manufactures a product, sells it, and instantly knows its profit margin, an insurance carrier sells a promise today, while its actual costs remain a total mystery for years, or even decades. Geopolitical conflicts, massive environmental mandates, or catastrophic industrial accidents mean one single bad event could wipe out an undercapitalized company overnight. So how does this asset actually print money? Here is where the strange financial alchemy happens. Mainstream wisdom says insurance companies make money by collecting premiums, holding onto them, and paying out less in claims. That is a complete illusion. To understand how it really works, picture a simple bakery. Imagine thousands of customers walk into your shop today and pay you upfront for a loaf of bread, but with a bizarre catch. They won't actually pick up that bread for 5 or 10 years. Meanwhile, you are sitting on a massive mountain of cash, and nobody is stopping you from taking that money and investing it into high-yield assets. In the commercial insurance world, this giant pool of collected cash is called the float. You collect hundreds of millions in upfront premiums from shipping lines, real estate empires, and pharmaceutical giants. You hold on to that vast reservoir, and you invest it into safe government bonds, corporate credit, and prime real estate. Even if your underwriting breaks completely even, meaning every dollar collected in premiums eventually goes right back out to cover claims and operational expenses, you still walk away with tens of millions of dollars. Completely for free, you are essentially operating a massive hedge fund, where your depositors pay you to hold their capital. Now let's step deeper into the shadows and reveal the dark world of corporate reinsurance. What happens when a commercial insurer takes on a risk so massive that a single disaster could bankrupt them instantly? Say, a $50 billion cargo port or a mega fleet of commercial airliners. They do not hold that entire risk alone. Instead, they turn to a secret secondary layer of the financial world, the reinsurance industry. Think of reinsurance as insurance for insurance companies. Global giants like Munich Re and Swiss Re operate in the background, quietly offloading slices of catastrophe risk from primary carriers in exchange for a massive cut of the float. It is a shadowy, global web of financial risk swapping, where billions of dollars move across offshore bank accounts every day, creating an invisible safety net that keeps global trade standing. And if this offshore syndicate decides to raise its rates after a major storm or conflict, the entire world feels the shockwave instantly. As ocean shipping rates spike, construction projects stall, and product prices jump at your local store. Now, look at how these primary companies engineer their operations behind closed doors to guarantee that profits keep rolling in. Commercial insurers do not just sit around gambling on high-stakes risks. They use ruthless systems of operational and psychological control. Take a massive chemical manufacturing plant. An insurer will never just guess a rate and send a bill. Instead, they dispatch a team of elite risk engineers to inspect every single square inch of the facility. They demand specific fire suppression systems, custom architectural layouts, strict worker surveillance, and modified operational schedules. And if the business owner dares to refuse, their insurance premium instantly rockets up by 300%, or worse, their policy gets canceled entirely. And in the corporate world, losing your commercial coverage instantly freezes your bank loans, halts your supply chains, and shuts down your business operations in a matter of hours. Insurers literally re-architect real-world industries from the inside out, using the constant threat of financial ruin to force total compliance. It is behavioral control disguised as risk management. And this control extends far beyond physical factories, right into the wild frontier of modern digital warfare. Cyber insurance. As hacker syndicates attack global corporations with ransomware, crippling entire supply chains overnight, commercial insurers have stepped in as the ultimate arbiters of corporate security. If a Fortune 500 company wants a cyber insurance policy today, insurers force them to hand over total access to their IT networks, demanding mandatory encryption protocols, continuous system surveillance, and strict operational constraints. If a firm refuses to comply with these digital demands, insurers simply cut off their coverage, leaving them one cyberattack away from total financial annihilation. In the digital age, commercial insurers are not just covering losses. They are dictating global cybersecurity standards from behind the scenes. Now consider another hidden engine powering this system, the weaponized science of actuarial mathematics. Behind every policy sits a quiet army of actuaries, mathematical assassins who use probability models, historical climate trends, and artificial intelligence to calculate human error and industrial failure down to the exact decimal point. They do not guess. They know the statistical likelihood of an oil tanker leaking, a bridge collapsing, or a factory catching fire long before it ever happens. By pricing risk faster and more accurately than anyone else on Earth, commercial insurers stay mathematically guaranteed to win in the long run. It is the ultimate house edge, far more precise and far more lethal than any casino floor in Las Vegas. But here is where the story takes a dark, dangerous turn. If this model is such an invincible financial engine, why do ultra-wealthy executives still manage to crash these giant carriers into bankruptcy? It comes down to two catastrophic, greedy errors that continue to destroy multi-billion-dollar empires. Look at the dramatic downfall of Reliance Group in the early 2000s. Mistake number 1. Underwriting for raw volume instead of actual profit. To crush their competitors, Reliance started selling commercial policies at insanely cheap prices, flooding their bank accounts with fast cash. They naively assumed that as long as they had a massive pool of cash to invest in the booming stock market, underwriting losses wouldn't matter. But when the market took a sharp downturn and major claims began pouring in, the investment returns evaporated, leaving behind a massive financial void. Mistake number 2, the deadly trap of long-tail liabilities. Reliance aggressively wrote policies for dangerous industrial risks like asbestos exposure and environmental toxins. The fatal problem with long-tail liabilities is that claims do not show up immediately. They lie dormant like a ticking time bomb, taking 20 to 30 years to explode. When those toxic claims finally flooded the company years later, the cash was completely gone. In a matter of months, a legendary multi-billion-dollar empire collapsed into insolvency, leaving policyholders stranded and erasing billions in value. And Reliance is not an isolated story. Look at what happens during black swan geopolitical events, like war or sudden international trade embargoes. When global conflict breaks out, billions of dollars worth of commercial ships, cargo fleets, and infrastructure get stranded or seized overnight in hostile territory. Carriers that failed to write precise war exclusion clauses into their policies face a sudden tidal wave of multi-billion-dollar claims all at once. In a flash, decades of carefully accumulated investment yields get wiped out in a few chaotic weeks, proving that even the strongest float engine can burn if risk management falters for a single moment. So let's run the real math. What does the ultimate payoff actually look like when executed correctly? Imagine you establish a mid-tier commercial insurance carrier with a starting capital of $500 million. By year 5, your company writes $1 billion in annual commercial premiums. After paying out claims, legal fees, and operational costs, those expenses swallow $980 million. On paper, your insurance business made a tiny profit of just $20 million. A paper-thin margin of just 2%. Sounds almost disappointing, right? Not so fast. Because throughout that entire year, you were quietly holding onto a $1.5 billion float and investing it at a steady 5% yield. That investment